Marcus buys a rental property. Caleb puts the exact same money into the stock market. 20 years later, one of them looks richer on paper, but the other has more freedom, less stress, in a portfolio that quietly exploded while nobody was watching. And the shocking part? The winner is not the one most people think. Before we break down the real numbers, hit like and subscribe if you want finance explained without hype, without fake motivation, and without people selling you a dream. Because by the end of this video, you may completely change how you think about real estate, stocks, and building wealth.
Let's keep this fair. Marcus and Caleb are both 32 years old. They both live in the same city. They both make about $68,000 a year. They both have saved $60,000. No inheritance, no rich parents, no secret business. Just two normal people with the same starting point. But they make two very different decisions. Marcus takes his $60,000 and uses it as a 20% down payment on a $300,000 rental property. It is a simple 3-bedroom house in a working-class neighborhood. Nothing luxury, nothing fancy. Just the kind of property people on the internet call a solid starter rental. He gets a 30-year mortgage at around 6.75%. His loan is $240,000. His monthly mortgage payment is about $1,557 before taxes and insurance. Then, Marcus finds a tenant willing to pay $2,150 per month. On paper, this looks beautiful. Rent, $2,150. Mortgage, $1,557. Difference, almost $600 per month. Marcus looks at the numbers and thinks, this is how wealthy people do it. I control a $300,000 asset with only $60,000 of my own money. That is leverage. That is real estate. That is the dream. Caleb does something much less exciting. He takes the same $60,000 and invests it into a broad stock market index fund. No tenant, no house, no keys, no I own property now feeling. Then he sets an automatic investment of $400 per month. He does not try to pick the next big stock. He does not day trade. He does not watch financial news every morning. He just buys the market and lets time do the work. Marcus has a house. Caleb has an app on his phone. Marcus can drive past his investment. Caleb can only refresh a screen. Emotionally, Marcus feels like he is winning immediately. And this is where most people make the first mistake. They compare how an investment feels instead of comparing what it actually produces after every cost is counted. The rent check is seductive. That is the number everybody talks about. My mortgage is $1,557 and my tenant pays $2,150. That sounds like $593 per month in profit. That sounds like $7,116 per year. That sounds like free money. But that is not profit. That is the top line before the property starts asking for its share. And real estate always asks for its share. First, property taxes. Marcus pays about $3,800 per year. Then insurance, another $1,700 per year. Then maintenance. Even if nothing dramatic happens, a house slowly breaks. Faucets leak, appliances die, paint fades, carpets get destroyed, doors get damaged, HVAC systems get old. A common rule is to set aside around 1% of the property value per year for maintenance and repairs. On a $300,000 property, that's about $3,000 per year. But some years are worse. A roof does not care about your spreadsheet. A water heater does not care that you are planning a vacation. A tenant does not care that you are counting on that cash flow. Then, vacancy. Even a good rental can sit empty. 1 month without rent means Marcus loses $2,150 in income, while the mortgage still has to be paid. Then, turnover costs. Cleaning, small repairs, new photos, listing, screening, time, stress, phone calls. And if Marcus hires property management, that can easily cost 8 to 10% of monthly rent. If he doesn't hire management, he saves money, but now he's bought himself a part-time job. This is the hidden math of real estate. The money doesn't just flow to you, it flows through the property first, and whatever survives is yours. In the first year, Marcus feels like unstoppable. His tenant pays on time, the house appreciates a little, his friends are impressed. At family dinners, people ask about the property. They say things like, "Man, you are building real wealth. You are smart. Rent is going up everywhere. Stocks are risky. Real estate is real." And Marcus loves hearing it, because real estate gives you social proof very quickly. People respect houses. They understand property. They can see it. They can touch it. It feels serious. Caleb, meanwhile, has nothing exciting to say. He tells people he invests in index funds. They nod, then they change the subject. Nobody asks him about expense ratios. Nobody claps because he bought the total market. Nobody says, "Wow, your automatic contribution is so inspiring." At the end of year one, Caleb's $60,000 might be around $68,000 if the market performs well, or maybe it drops to $54,000 if the market has a bad year. That's the problem with stocks. They don't give you emotional comfort in the beginning. They give you volatility. They give you doubt. They give you a number that moves every day and tries to test your patience. Marcus gets rent checks. Caleb gets uncertainty. So in year one, Marcus feels like the winner. But year one is not the game. The game is year 10, year 20, year 30, and that's where the math starts getting uncomfortable.
After 3 years, Marcus has collected about $77,400 in rent. That sounds incredible. But now let's subtract the real costs. Mortgage payments over 3 years, about $56,000. Property taxes, around $11,400. Insurance, around $5,100. Basic maintenance and repairs, maybe $9,000. One vacancy period, $2,150 lost. Cleaning and turnover, $800. Small repairs between tenants, $1,200. Suddenly, that $77,400 in rent does not look like $77,400 anymore. After everything, Marcus may have made only a few $1,000s in actual cash flow. And that is if nothing terrible happened. No eviction, no major roof issue, no lawsuit, no long vacancy, no tenant destroying the property. On paper, he was making almost $600 per month. In reality, after costs, he might be making closer to $100 per month, maybe less, maybe negative. But Marcus still has one powerful advantage. The property itself has gone up in value. If the house appreciates at around 3.5% per year, his $300,000 property is now worth about $333,000. His mortgage balance is around $232,000. That means his equity is roughly $100,000. This is where real estate becomes powerful. Marcus put in $60,000. 3 years later, his equity might be around $100,000, not because the cash flow was amazing, but because leverage magnified the appreciation. That is the real engine of many real estate returns, not the monthly rent, the leverage. The tenant helps pay the debt, the property rises in value, the bank's money works for you. That part is real, that part is powerful. But it comes with stress, debt, concentration, and responsibility. Caleb, on the other hand, has put in his original $60,000 plus $400 per month. After 3 years, assuming around 9% average annual returns, his portfolio may be around $95,000. He is slightly behind Marcus's equity. But Caleb has done almost nothing. No calls, no repairs, no property taxes, no tenant screening, no emotional drama, no $240,000 mortgage, just consistency. And at this point, most people would still say Marcus is winning, but the race is just beginning. The stock market is boring in the beginning. That is why most people quit before the magic happens. The first few years feel slow. You invest money, it goes up, then down, then up again, then sideways. You wonder if you are doing something wrong. You see someone online making money with rentals, Airbnb, wholesaling, crypto, or some business idea. And your index fund feels embarrassing. But compounding does not care about being impressive. It cares about time. The first $100,000 is slow.
The next $100,000 is faster, and the next one can happen even faster, because eventually your gains begin creating gains of their own. Caleb is not just investing $400 per month. His portfolio is also producing growth, and then that growth produces more growth. At first, the contributions are doing most of the work. Later, the portfolio itself becomes the worker. That is the invisible shift. In real estate, Marcus has to keep managing the asset. In stocks, Caleb's asset keeps scaling without requiring more phone calls. That does not mean stocks are better in every situation. It means the difficulty is different. Real estate is operational. Stocks are psychological. Marcus must manage tenants, debt, repairs, and local risk. Caleb must manage fear, patience, volatility, and behavior. And honestly, both are hard. They're just hard in different ways.
By year 7, Marcus is more experienced. He is no longer naive. He has had good tenants. He has had annoying tenants. He has had months where the property felt like the best decision of his life, and he has had months where he wondered why he ever wanted to become a landlord. The rent has increased from $2,150 to maybe $2,450. That helps. But taxes have increased too. Insurance has increased. Maintenance costs have not disappeared. The property is older now. And older properties do what older properties do. They ask for money. Maybe Marcus replaces the HVAC system for $7,500. Maybe the roof needs repairs. Maybe a tenant leaves and the house sits empty for 6 weeks. Maybe the city changes inspection requirements. Maybe insurance gets more expensive. This is why the monthly cash flow number can be dangerous. It gives you confidence before the property has tested you. By year 7, Marcus's property may be worth around $382,000. His mortgage balance may be around $218,000. That gives him equity of roughly $164,000. That is impressive. Real wealth has been created, but it was not passive. It was not effortless. It was not as clean as the spreadsheet promised. Caleb, meanwhile, keeps investing $400 per month. If he earns around 9% per year on average, his portfolio may be around $159,000 by year 7. Now they are very close. Marcus has more control. Caleb has more liquidity. Marcus has an asset he can rent. Caleb has an asset he can sell in seconds. Marcus has leverage. Caleb has diversification. One bad tenant can hurt Marcus badly. One bad company barely affects Caleb. But one market crash can make Caleb's portfolio fall hard. This is not a simple fight between good and bad. This is a fight between different types of risk. If this breakdown is helping you see the numbers differently, hit like and subscribe. Most people only hear the emotional side of money, like real estate makes millionaires or stocks always win long term. But on this channel, we look at the full math, the money, the risk, the time, and the stress. Real estate has one advantage that stocks do not easily give the average person: leverage. Marcus used $60,000 to control a $300,000 asset. That is a 5-to-1 effect. If the property goes up 10%, the house gains $30,000 in value. But Marcus did not invest $300,000. He invested $60,000. So that appreciation can create a very strong return on his actual cash invested. This is why real estate can create wealth fast. The bank's money is involved. The tenant helps pay down the loan. Inflation can push rents higher, the property can appreciate, and the tax system often gives real estate investors advantages: depreciation, mortgage interest deductions, expense write-offs, potential capital gain strategies, and in some cases, 1031 exchanges. This is why experienced real estate investors do not think like casual landlords. They think like operators. They buy carefully, they negotiate aggressively, they understand local markets, they screen tenants properly, they keep reserves, they track every expense.
They treat real estate like a business. And when real estate is treated like a real business, it can outperform stocks. But here's the catch. Most people do not buy like professionals. They buy because someone online said, real estate is the path to wealth. They run the numbers with optimism. They underestimate repairs. They forget vacancy. They ignore their time. They assume rent always goes up. They assume appreciation will save them. And then they discover that a rental property is not just an investment, it's a business wearing the costume of an investment. That distinction matters because businesses require systems, and if you do not build systems, the business becomes your problem. Stocks have a different advantage. They scale quietly. Caleb does not need to find a tenant to invest another $400. He does not need to call a bank. He does not need to inspect a property. He does not need to close a deal. He does not need to sign paperwork every month. He just invests. That simplicity is boring, but simplicity is also powerful because the easier a strategy is to repeat, the more likely people are to stick with it. Caleb can increase his monthly contribution from $400 to $600 without adding a second job. He can do it with one setting in his brokerage account. That extra $200 per month can change the entire long-term result. At 20 years, Caleb's portfolio with $400 monthly contributions might grow to around $628,000. But if he increases to $600 per month, that number may move closer to $760,000. That is the power of contributions plus compounding. In real estate, if Marcus wants to scale, he usually needs another down payment, another mortgage, another tenant, another inspection, another roof, another set of risks. That does not mean scaling real estate is bad. Many people build serious wealth doing it. But scaling real estate requires operations. Scaling index investing mostly requires income, discipline, and time. This is why stocks are underestimated, not because they always outperform, but because they are easier to continue. And in personal finance, the strategy you can keep doing for 20 years often beats the strategy that looks amazing for 6 months. By year 10, Marcus's property may be worth around $423,000. His mortgage balance may be around $205,000. That puts his equity around $218,000. That's a huge jump from his original $60,000. Even if the property did not produce much cash flow, the equity growth is real. Marcus is not broke. He did not make a stupid decision. He built wealth. But look at what it required. He held a leveraged asset for 10 years. He dealt with tenants. He accepted debt. He managed expenses. He concentrated risk in one property. He gave time and attention to the investment. Now, Caleb, with $60,000 invested up front, $400 monthly, and around 9% average annual returns, Caleb may have around $224,000 after 10 years. That's almost the same level of wealth. But the path was completely different. Marcus built equity through debt paydown and appreciation. Caleb built wealth through compounding and consistency. Marcus had more control. Caleb had more freedom. Marcus had an asset he could touch. Caleb had an asset he could liquidate. Marcus had tenants paying rent. Caleb had companies generating profits inside an index. At year 10, this is the uncomfortable truth. Real estate may not destroy stocks. Stocks may not destroy real estate. When you count everything, they can be much closer than the internet wants you to believe, because the internet does not reward nuance. It rewards extreme statements. Real estate makes you rich. Stocks are the only smart investment. Rentals are passive income. The market always wins. But real life is not that clean. Your result depends on purchase price, interest rate, rent, taxes, maintenance, market returns, behavior, and time. The winner is not the asset class. The winner is the person who actually understands the math.
Now, let's jump 20 years forward. Marcus is 52. Caleb is 52. Same starting money, same timeline, different lives. Marcus's property may now be worth about $597,000 if it appreciated around 3.5% per year. His remaining mortgage balance may be around $136,000.
That gives him around $461,000 in equity. Very strong. And if rent has continued to rise, the property may now produce much better cash flow than it did in the early years. That is one of the hidden strengths of real estate. The early years can feel tight, but over time, rents may rise while the fixed mortgage payment stays the same. If Marcus survives the first decade and manages well, the second decade can become much more rewarding. But after 20 years, he has also faced 20 years of property ownership, repairs, turnovers, insurance increases, tax increases, potential tenant issues, major capital expenses, time, mental load, and possibly refinancing, inspections, city rules, or market cycles. The equity is real, but the work was also real. Now, Caleb, his $60,000 initial investment plus $400 per month at around 9% average annual returns may be worth about $628,000 after 20 years. He invested a total of $156,000 over that period. The rest came from growth. No tenants, no mortgage, no emergency plumbing call, no vacant unit, no roof replacement, no property manager. But he had to survive market crashes. He had to keep investing when the market was red. He had to avoid panic selling. He had to trust a boring strategy when everyone else was chasing exciting ones. That is the price of stock investing. You do not pay with phone calls and repairs. You pay with emotional discipline. And most people underestimate how expensive emotions can be. A bad tenant can destroy a landlord's year. A panic sale can destroy an investor's decade. Both strategies have traps. They just hide in different places. Real estate can win big, but usually not because someone casually bought a house and hoped. Real estate wins when the purchase price is right. It wins when rent is strong compared to the price. It wins when the financing is manageable. It wins when the investor has cash reserves. It wins when the property is not secretly full of expensive problems. It wins when the market has job growth, population growth, and rental demand. It wins when the investor treats it like a business. Real estate also wins through strategies that stocks cannot copy. House hacking, buying a duplex, triplex, or fourplex and living in one unit while renting the others. That can reduce your personal housing cost dramatically. Forced appreciation, improving a property, raising rent, increasing net operating income, and making the asset more valuable. Tax advantages, depreciation and expense deductions can be powerful when used correctly. Inflation protection. If rent and property values rise over time, the landlord may benefit while paying back debt with dollars that are worth less in the future. And leverage. When used wisely, leverage can accelerate wealth, but when used poorly, leverage can destroy you. That is the part people skip. Leverage is not magic. Leverage is a knife. In skilled hands, it works. In careless hands, it cuts. Stocks can win when the investor stays consistent. That sounds too simple, but it is the whole game. Caleb does not need to be brilliant. He needs to be patient. He needs to avoid panic. He needs to keep fees low. He needs to invest regularly. He needs to avoid trying to predict every crash. He needs to understand that volatility is not the same as failure. Stocks also win when freedom matters. Caleb can move cities without selling his investment. He can travel without worrying about a tenant. He can increase or decrease contributions easily. He can sell a small portion if needed. He can diversify globally. He can invest inside retirement accounts. He can automate the process. And automation is powerful because it removes drama. Most people do not lose money because they chose the wrong asset class. They lose money because they cannot stay consistent long enough for the asset class to work. They get excited at the top. They get scared at the bottom. They change strategies every year. They compare themselves to strangers online. They buy what is trending. They sell what is boring. And then they wonder why wealth never compounds. Caleb's real advantage is not that stocks are perfect. His advantage is that the system is simple enough for him to repeat for 20 years. The real question is not which makes more money, real estate or stocks. The better question is, which one can you actually execute for 20 years without destroying your finances, your sleep, or your discipline? Because the best investment on paper is useless if you cannot live with it. If you hate dealing with people, real estate may be harder than you think. If you panic every time the market drops, stocks may be harder than you think. If you have unstable income, taking on a large mortgage for a rental may be dangerous. If you have no discipline to invest monthly, stocks may never compound for you. If you are handy, patient, and willing to manage operations, real estate may fit you. If you value freedom, simplicity, and liquidity, index investing may fit you. If you want the strongest long-term plan, the answer may eventually be both. Own productive assets, some liquid, some physical, some diversified, some income-producing. But do not choose based on hype, choose based on math, choose based on risk, choose based on your personality, choose based on what you can actually maintain. Because wealth is not built by the investment that sounds best in a video title. Wealth is built by the investment you understand well enough to keep holding when it becomes uncomfortable.
Marcus ended with a valuable property. He built equity. He used leverage. He may now have rental income that grows over time. But he paid for that return with responsibility, debt, repairs, tenants, illiquidity, and concentration risk. Caleb ended with a large portfolio. He used diversification. He used compounding, he used automation, he kept his life simple, but he paid for that return with volatility, uncertainty, market crashes, and the emotional challenge of staying invested. So who won? If we only look at net worth, Caleb may be ahead in this version. But if Marcus bought a better deal, managed well, and used tax advantages wisely, he could win. If Caleb increased contributions, stayed invested, and avoided emotional mistakes, he could win. That is the real answer. Not real estate always wins, not stocks always win. The person who counts everything wins. The person who includes taxes, repairs, vacancy, fees, interest, time, behavior, stress, and opportunity cost, that person wins. Because bad math is expensive, but incomplete math is even worse. If this video changed the way you think about real estate versus stocks, hit like, subscribe, and comment below, Team Real Estate or Team Stocks. And remember, the next time someone tells you one investment always beats the other, ask them one simple question. Did you include everything? Because the answer that includes everything is the only answer that matters.